Okay, thanks. First of all, thanks for the invitation to this non-intellectual challenging roundtable. And thanks God I have a non-intellectual challenging set of transparencies to transmit to you. So it's a perfect matching. So,
just 1 point. The motivation was not challenging, but the outcome it will be for sure.
Okay, so after this, so I'm going to talk about Spain, but also I'm going to talk about the comparison between Spain and the U.S. and be a little bit broader than what I was asked to do, and I hope to do that quick, not that quick. Okay, so first of all, I wanted to talk about the triumph of nonsense. Okay, because 1 year ago, or 1.5 years ago, everybody was talking about the decoupling. Probably nobody remembers that any longer. But that was a nonsensical, the most nonsensical thing that I've heard said by economists or pseudo-economists. And so Europe and the US, they are decoupled. Financial system, real economy, they are separated. And the housing sector in the US is one thing, and the housing sector in Spain is another thing, even though the financing is global. But anyway. And then the other theory that was very popular was the theory of soft landing, okay, another great theory of our days. Okay, so what I want to talk about is basically the central role of housing prices in all these problems that we're having now. Okay? The theory is very simple. The theory is that a bunch of people, not only banks, but also individuals, everybody made a bet. And the bet was housing prices cannot go down in nominal terms, okay? And that creates a huge systematic risk because everybody is doing exactly the same bet, okay? How large was that bet? Well, just an example. This guy, John Paulson, made last year $3,500 million, repeat, $3,500 million betting in short positions against housing. This guy, just one guy. Imagine how many people were happy to take the long positions on that, okay? Mm-hmm. So we reached that point. Now, why in the US they were doing that bet? Two reasons. First of all, because historically the nominal price of housing have never gone down in the United States, the aggregate price, okay? The nominal regional prices have gone down, but the aggregate never went down, at least in 4 of the price indices that we have today are available. The 5th one, which is a more recent one, which is the Case and Siller repeated sales index, that one, when you go back, there were some years in which nominal prices in the aggregate were down, okay? But in 2000, nobody knew that because that index didn't exist, okay? Anyway. Now, the other issue was the issue of synchronicity. So since 2000, what you observe in regional markets in the US and also in countries in the world is synchronicity. There is a boom all at the same time. Okay? This didn't happen before the 2000 in the regional markets in the US. Therefore, that meant that if you have national prices that do not go down in aggregate terms, and then you have some recession, rolling recession, and overlapping problems in different areas of the housing market in the US, that means that you can use regional diversification to hedge against that risk. You can buy as many houses, as many derivatives from houses you want, because you are hedging. In a way, you are hedging. Okay. But then you have this rare event, which is that the aggregate price starts going down. Okay. And everything collapses. The first moment this starts, everything collapses. And the system went to a point in which Richard Disney was giving a seminar, I think on Tuesday, and he was saying that he would receive at home letters saying, how much money could you take on equity in your house because of the increase in the price of your house, because the bank had a model to predict prices, and using those predicted prices, they will send you a letter saying, you can take $100,000 more on your house right now, okay? But this happens 2 weeks ago. He was still receiving that letter 2 weeks ago, okay? So imagine how, fucked the system was. Okay, anyway, so the whole problem of this is very simple. It's really very simple. It's a problem of incentives. So this is basically what happens. when prices of housing, when you bet on the price of housing going up always, then everybody in this diagram has the wrong incentives. The families have the wrong incentives because they buy a house that they cannot, they will not be able to pay, but it doesn't matter, because if the price goes up, then I'll keep the house. If the price goes down, I go away, okay? It's not like in Spain. There, you return the house and the debt is over. In Spain, you know that is not so easy, okay? But there it's as easy as that. So you have the upside part, the good part for you, and the bad part for the bank. What are the banks doing? Well, the incentives of the executives of the banks are clear, but also the banks were playing with the increase in the price, the future increase in the price, because they were doing a lot of refinancing, and because they were thinking that if the price will go up in the future, even if the guy returns the house, that asset is more valuable, so that's fine. That's a perfect deal. Now, how the banks mislead rating companies, they didn't have to. They didn't have to, because the rating agencies had the wrong incentives. The rating agency, so you go to the rating agency and say, look, I have this SIV, and I want to generate some bonds to send to CDOs, whatever bonds to send to the market. Give me a price for them. And they will say, I'll give you A. And they'll say, I'm sorry, that's not enough. Give me AAA, or I'll go what they call rating shopping, which means you go to another one, you go until somebody gives you AAA. And at that point, you stop. Why? Because the incentives are wrong, because the one that pays for the rating is the bank. It's not the investor that is going to buy the asset. It's the bank that pays for the rating. Therefore, the incentives are precisely wrong. In the past, in the 50s and in the beginning of the 60s, the incentives were right. The people that pay for the rating were the investors. So the bank would say, I have these bonds, and the rating agency, an investor would go to a rating agency and say, give me a rating for that, okay? Those were the right incentives. Today, they have the wrong incentives. And now at the end, we have the investors. What are the incentives of investors of buying that garbage, basically? And the incentive is that they were desperate to find any asset where they invest this enormous liquidity that was generated by low interest rates, oil rents, et cetera, et cetera. They will go to the stock market and put the prices up all over, and they will say, we need more assets, more assets, more assets. Where can we find more assets? Look, we have all these houses. Just securitize everything, okay? And you get enough assets for anybody that wants those assets. So basically, all the incentives were wrong. Now, I'll go with, from the 5 theories that Xavier talked about before, I'll talk about the Ponzi, the last one, because I think is the one that was driving this whole system. So there were clear signs of a bubble. There were very clear signs of a bubble. There was a large increase in the ratio of house prices to disposable income. There was very small return to housing. And there were gain expectations that were unrealistic, with a very low perception of risk and backward looking. Okay. And altogether is a recipe for disaster. Have a look to, these are the prices of several countries. The index is 100 in 1988. And here you have, this is nominal because debt is also in nominal terms, but in real terms, in the last 10 years, the difference will not be so interesting. So you have 2 types of countries. One is Spain and Ireland, with huge and very fast increase in prices. And then you have the US and the UK, with large increase in prices, but I mean, in relative terms, small.